Hey, welcome back. Welcome back to Pass Your Life and Health Insurance Exam Podcast. I'm your host, Beko. I'm very excited to have you back here. So, I hope you guys are enjoying your summer so far. Ah, man, time is flying. It's already, we're already in September. Uh, if you live on the East Coast like me, uh, you can already feel the weather changing already. It's getting a little chilly. It's getting darker uh, early now. I think it's sun starts to set and it starts to get dark. I think after by 6, 7 o'clock is dark. So things are changing. I see the leaves are starting to fall a little bit. The leaves are starting to, change colors. Uh, so they're going from green to yellow. It tells you that fall is right around the corner. So, but hey, I know it's been a while since I did any training episode. For the last, I think 3 or 4 episodes has been, they've been mostly or just testimonials and updates. So what got me to record this episode, I got a call from one of my loyal listeners. Her name is Melinda. Melinda, this is a shout out to you. Uh, I just spoke to her today, actually. Well, she contacted me yesterday, and and we talked today. She's from the state of Arizona, so she sent me this beautiful text. And we talked. She just went on and on. Oh, your podcast is so good. I'm learning so much from it. I read your reviews. I said, reviews? uh, for some reason, guys, I've tried to check my reviews, the podcast reviews, but for some reason, I can't see them. I don't know. Maybe maybe I need to log in as a guest or something, but I cannot see any reviews. So pretty much what I go by is, are people calling or texting me like Melinda did. She contacted me. She wants a one-on-one training, so she contacted me and she went on and on. It just made my day, right? To just hear someone tell you, that what you're doing is actually helping them. That helps make my day. So I told her, what, Melinda, since you did this, I'm going to actually record an episode because you just made my day. And I know some of you are parents, so you know the trick. If you want your kids to do something, the trick is uh, praises, right? If you want someone to do something, offer them a lot of praises. Trust me, that person will want to do more. So for some reason, every time I get some of these phone calls and people tell me how much this podcast means to them, how much it has helped them, it makes me want to do more. So Melinda, this is a shout out to you. You made me uh, want to record this episode now because I'll be honest, it gets tiring sometimes. So I'm very busy. I have my financial business. I have a lot of clients, and I have about 75 agents spread across 24 states. So I'm very busy, but I still try to find time to do this podcast. So Melinda, again, this is a shout out to you. Thank you very much for the compliments. So I'm going to just share some stuff here with you guys. And today we're going to talk about variable insurance. What's the difference between variable and fixed, or variable and regular insurance? Uh, it depends what state you're in, but most of the states, I know Texas has this on their exam outline. Arizona has this on their exam outline. DC, Iowa, Connecticut, Florida, Georgia, Delaware, uh, um, Massachusetts, Maine, Mississippi. All of these states have variable, variable life insurance, universal life insurance, variable whole life. They have them on your exam outline. So a lot of you would benefit from this, and I'm pretty sure it should be on the other outlines for all of the other states. So let's talk about variable. First of all, before I start, I won't go into too much detail, but you know the difference between term and permanent insurance, right? Again, I'll probably do another episode, going over the difference between term and permanent insurance. We know that, let's just do some quick highlights. We know that term insurance is when you hear term actually means temporary, all right? It's an abbreviation. So when you hear term, think temporary. It will come to an end. Think about renting a house or an apartment. Whether you sign a 1-year lease or 2-year lease, but at some point, that lease you have will come to an end. So that's what term insurance. So term insurance is just short term. It can be 5 years, 10 years, 30 years, but it has an end. I don't know of any term that goes past 30 years. So most of the time it's 30. So term is like it's like renting, and and you renew at the end of your term, at the end of your lease. You don't build any equity. There is no cash value. Again, cash value just means savings account that's attached to a life insurance. You don't have any of that. Term insurance starts out being very cheap. On average is about 5 to 10% of the cost of a permanent life insurance policy. I just ran a quote for one of my agents. I know one of my clients last week. She was going to get she's what 30 years old. Yeah, so she was going to get a $500,000 term. The $500,000 term was going to run her around, I think, around $21 a month. Whereas the same thing for the permanent insurance, it was going to run her around, I think, between like $181 to $200, right? So almost 10 times. Same amount of coverage, but one is term and one is permanent. So permanent is more expensive, term is cheaper. Term has no savings account. It has pretty much no living benefits. The only exception being terminal illness rider. So all life insurance policies come standard with terminal illness rider. And again, you can go and listen to that episode on policy options, provisions, and riders. I went more into that. So that's term insurance. Permanent insurance, on the other hand, is like you own a mortgage, right? You own a house. Your payment is fixed. So if you're paying $50 or no one pays $50 for mortgage. So let's say you're paying $2,000 a month for your mortgage. You know that your mortgage payment, in interest and principal will be fixed, right? And that's for the rest of your life. Well, technically until age 100, but very few people live until age 100. All right. So permanent insurance starts out being more expensive, but your premium is fixed for life. And what permanent insurance also has, it has something called a cash value. Well, I mean, I like to break these terms down, bring it down to your level, to find synonyms, words that everybody can relate to. So when you think about cash value, just think about savings account, okay? So permanent life insurance has a savings account attached to it where or percentage of your premium goes into that savings account, right? And on average, it can be about 60%, 60 to 70% of the money of your premium goes into that savings account. So it's a form of forced savings. So every month or every year or whatever you pay, you make your premium payments, then your savings account builds up, right? So if you have a savings account and you are putting money in that savings account every month, common sense will tell you that your savings account will increase, right? So it's the same thing with your cash value, your savings account in your life insurance policy. So every month you pay your premium, right? Your cash value will increase. Now, when it gets to a point, after it depends again how much you're putting, but after a couple of years, you can be able to take money out, because what's the point of having savings account if you cannot take money from it, right? So when your cash value reaches a certain point, you can take money out as a withdrawal, or you can take money out as policy loan. So, and you can use your permanent life insurance for so many things. You can use it for retirement. You can use it for as a savings account. You can use it for college savings fund. You can use it also as a healthcare account. So you can use your permanent life insurance for so many things, whereas term is limited, but it's cheap. So for clients who have a short-term, insurance need and can afford temporary, can afford permanent insurance, we go with term insurance. So that's just the general, those are the two big umbrellas of life insurance: term and permanent. So think term has no cash value. It has no savings account. It's like renting. You build no equity. You can have a term insurance for 30 years. If you decide to cancel it, you walk away with nothing, right? Zilch, nada. If you miss payment for more than 1 month for term insurance, you lose all that money. It's almost like you rent a house, guys. You can rent a house for 5 years and you miss your payment for 1 month, and your landlord kicks you out and you walk away with zero, right? But if you own your own house and you decide to walk away, you can sell that house for cash, right? So permanent life insurance is like owning a house. You build equity in it, and that equity is called your cash value. All right. So those are the two big, major types of life insurance: term and permanent. Now, under permanent, you have different types of insurance. You have whole life. Whole life is the most common permanent insurance. You shouldn't get me started on whole life. I mean, it's okay, but I don't think it's the best. So you have whole life, you have universal life, you have adjustable life, you have then under universal life, you have index universal life, you have variable universal life. Then under whole life, you have so many types of life insurance under under whole life, right? You have ordinary or straight whole life. You have single premium whole life. You have limited pay whole life. You have graded premium whole life, modified whole life, variable whole life. So you have you have interest sensitive whole life. Another name for that is current assumption whole life, right? So you have different types of permanent life insurance policies. Now, the type of life insurance policy we're going to talk about today is we're going to contrast variable and just your regular life insurance, right? So let's talk about variable. Now, when you think about variable, what comes to mind? Variable. For example, if you want to buy a house and it told you that your interest rate was variable, well, you know that it can go up, it can come down, right? So variable is anything that changes. So you have life insurance that are variable, and you have two types of variable life insurance. You have variable whole life and variable universal life. Again, what are the two types of life insurance? You have variable whole life and variable universal life insurance. And then everything else, is just regular insurance. But before we can go further into the difference between variable and regular um, insurance, right? Or we can call it fixed insurance. Before we can go further, let's go ahead here with some questions. Okay. So again, like always, I like for these episodes, I prefer, or I'll recommend that you have a pen and paper. You want to at least attempt to answer these questions. Okay. So attempt to answer these questions. So let's go over some things here quickly. So let's go over some questions. So question number one, all right? Question number one here is, which statement is true about a variable universal life policy? A, policy owner cannot select the premium mode. However, the policy holder directs investment. B, policy owner has control over where the investment goes and selects the amount of the premium payment. C, all of the policy holders' premiums go into the insurer's general account. D, the policy owner has no control over the premium, over where the premium is invested. Again, what is the correct answer? Okay, let me repeat that. Which statement is true about a variable universal life policy? A, policy owner cannot select the premium mode. However, the policy holder directs investment. B, policy owner has control over where the investment goes and selects the amount of the premium payment. C, all of the policy holders' premiums go into the insurer's general account. D, the policy owner has no control over where the premium is invested. So what is the answer? I want you to write it down. So for this episode, I don't recommend you driving and listening to this. No, you're sitting down, you're trying to take notes and guess the answer. Okay. So what's the answer for that? The next question here is a blank insurance has a guaranteed minimum death benefit. The face amount can increase or decrease based on how well the stock market performs. It also affords the policy owner the choice of sub-accounts to which cash value can be assigned in a fixed premium. A, equity indexed universal life. B, variable life. C, graded whole life. D, variable universal life. Okay, so that's question number 2. Let's come here to question number 3. Question number 3. It says, which one of the following types of life insurance requires that the producers be licensed by the Financial Industry Regulatory Authority before they can sell the policy? A, adjustable life. B, variable annuities. C, variable life. C, universal life. And D, variable universal life. Again, question number 3 says, which one of the following types of life insurance requires that the producers be licensed by the Financial Industry Regulatory Authority before they can sell the policy? A, adjustable life. B, variable annuities. C, universal life. D, variable universal life. So what is the answer. So those are 3 questions. Again, those are just sample questions. For those of you who are fortunate to do our one-on-one training, you know you have you have tons of questions. You have too much. You have too many questions. You probably get tired with tired with questions. So that is just a sample. Okay. So what is the answer now? If you answer all 3 correctly, that means you really understand this topic very well. You can choose not to listen to the rest of this. But if you got all 3 wrong, or if you got only 1 right, then you want to listen to the entire episode. All right. So let's come here to variable versus fixed. All right. So just some things to write down. And again, I hope you have a pen and paper or you have your laptop, you are taking notes. Number 1, variable insurance. What happens with variable is your investment, right? The money in your cash value is invested directly into securities. Again, securities are investments that that you have the potential to lose some or all of your money. So what are some example securities? Well, be mutual funds, stocks, and all of those things, right? So those are considered securities because you can have your stock and you can lose all of them. You can lose the entire thing, right? Or you can have your mutual fund, you can lose almost everything in it. So securities are any investment that you stand the potential to lose or a greater portion of it or all depending on stock market performance. Okay, so variable insurance policies are securities. Now, you have to understand that the federal government usually, well, I'm going to step back here. So you guys should know this, but it will probably be on your test because I know it's on the exam outline for a lot of states. So if I were to guess, it will probably be on your test. But in 1945, the federal government and the states government struck a deal. The federal government said, okay, states, we are going to step away from being the primary regulators of insurance, provided you regulate insurance in your states the right way. So that compromise was called the McCarran-Ferguson Act. Okay, so that was the act, that was the law that Congress passed that gave states the primary responsibility of regulating insurance. Okay, so more than likely that will probably be on your exam. So you want to know that the 1945 McCarran-Ferguson Act gave states the primary regulatory authority of insurance products. Now, there's an exception to that. For security products, the federal government steps in. So the federal government will regulate security products in addition to state governments. They'll regulate, in this case, insurance that are security products in addition to in addition to the State Department of Insurance. All right. So variable life insurance and variable annuity, by the way, annuity is an insurance product. That is why it's on your exam, okay? Because annuity is sold by insurance company, it is an insurance product. Again, I have an episode on annuities. I think it's more than 1 hour. You can go and listen to that in detail. So the federal government say, okay, states, you are responsible for regulating insurance, but hold up, variable insurance products, again, variable life insurance and variable annuities, those are too risky because now, uh, the public, policy owners have the potential to lose all their money. So you know what? We need to help you to regulate these products, right? So we're going to step in. We're not going to take over, but we're going to regulate it jointly with you, right? So again, just I'd like to simplify this because once it's simplified, I break it down, you can be able to understand it. And no matter how they twist the question, they can twist it, turn it upside down, you're still going to get it right once you understand the concept. So the reason the federal government stepped in to regulate insurance products is variable insurance products is because they are very risky. They are considered securities. Securities are any type of investment that you stand to lose a big portion or all of your investment if the stock market does poorly. Okay, so the federal government step in and regulates variable life insurance and variable annuities. Why? Because they are considered security products. Why are they considered security products? Because clients have the potential to lose all, a great portion of their investment or all of their investment. That is why the federal government steps in to regulate variable products in addition to state government. So number one, just some things. Number one, for variable insurance products, you need 2 licenses to sell it. So, to sell them. So as an insurance agent, you need a securities license. Again, the key is securities. I told you securities are any financial products that a client stands a great chance of losing some or all of that investment if the stock market goes down. Okay, so in order to sell those products, you must have something. You must have a license, and that license is called a securities license. At some point, our securities license, but I got rid of my license. That's a story for another day. So to sell variable insurance products, you as the insurance agent or the producer on your exam, though most of the time we use producer instead of agent. Producer is the same as agent. So as a producer, you need to have 2 licenses to sell variable insurance products. You need a securities license and a life insurance license. Again, what are the 2 licenses you need to sell security products or to sell variable insurance products? Again, you need a securities license and a life insurance license. That's the first thing. Second thing, who regulates variable insurance products? Again, what are the 3 types of variable insurance products? You have variable annuity, you have variable whole life. On your exam, most of the time, they won't use variable whole life. They'll just say variable life. But just know variable life is the same as variable whole life. Then you have variable universal life. So if it is variable life, if it doesn't say variable universal life, it says variable life, it's variable whole life. Okay, so those are the 3 types of variable insurance products: variable annuities, variable whole life, and variable universal life. So to sell any of those products, you need to be licensed by both the state Department of Insurance or by the state and the federal government. What license do you need? You need a securities license and a life insurance license to sell those products. Now, what are the agencies that regulate these products? Very key. So for the federal government, you have 2 agencies that regulate variable insurance products. They are FINRA, FINRA. That stands for Financial Industry Regulatory Authority, FINRA. And the second federal agency is SEC, Securities and Exchange Commission. And then at the state level, you have the State Department of Insurance. So those are the three regulatory bodies that regulate variable insurance products. Now, so on your exam, they may say which of the following regulates variable insurance products. They may say SEC and and State Department of Insurance, or they may say FINRA and State Department of Insurance, or they may say FINRA, SEC, and State Department of Insurance. The most correct answer will be SEC, FINRA, and State Department of Insurance. But if you see either SEC or FINRA and State Department of Insurance, if those are the only options, then that's the most correct. Okay, so now let's talk about the investment. Unlike regular insurance, if you got a whole life policy or universal life policy or adjustable, whatever it is, it's permanent, the insurance company bears the investment risk. So if you got a whole life policy, insurance company say, okay, you know what, Melinda, this is a shout out to you, Melinda. They say, Melinda, we're going to give you, 2% interest, every month, right? So now the insurance company bears the investment risk. So it doesn't matter whether the investment, whether the insurance company makes money from the investment or not. You, Melinda, you know that, hey, at the end of the month, I'm paying my premium. I know every month I'm getting 2% interest, or whatever it is, I'm getting 1% interest, whatever the interest is, right? But for regular insurance, you as the policy owner, you as the insurer, you don't bear any risks, right? Pretty much guaranteed. For variable products, remember I said variable products are securities, and securities are any financial vehicle or product that you stand to lose most or all of your money if the stock market does bad. So, unlike regular insurance, variable insurance products, you as the owner bear all of the investment risks. So yes, I have a variable life insurance, and and maybe the stock market is going up. It's a bull's market, and the stock market is up 20%, 30%, and man, I am killing it. I mean, my account value is up 30, 40, 50%. Great. But if the stock market does bad, like it did, less than 2 years ago, when COVID happened, the stock market went down about roughly 35% in 2020, right? Less than 2 years ago. So if that happens, and now you have a variable life insurance or variable annuity, oh crap, now you just lost 30% of your account value, right? So just keep in mind, for variable products, you as the owner bear all of the investment risks. So you can make a lot of money, but you can also lose a lot of money. And some people like the risks, some people don't like it, right? Now, the other thing too, you as the owner, you direct the investment. So you call the shots. You can decide, okay, you know what, I want you to invest. I want you, insurance company, I want you to buy, to invest my premiums in, in this mutual fund or in this type of stocks. I want to invest in blue chip stocks or whatever, right? But you, as the owner, you control that investment, right? You have the option, even though a lot of people don't exercise this right, but you as the owner, you have the right to dictate. If you are variable insurance owner, variable insurance policy owner, you have the right to direct your investment. On the exam, you may say, direct investment, control investment, all means the same. Again, for regular insurance, because you are not taking in any of the risks. The insurance company decides how they're going to invest your money. You don't care as long as they gave you what they promised. Okay, if they promise you 2% or 5%, if they're giving that, everything is kosher. You're good. Now, with variable products, as I said, there are no guarantees. You as the owner bear all of the investment risks. Again, the key word is bear all investment risks. So on the exam, you may say, which one of the following, which one of the following life life insurance policies does an owner bear all investment risks? A, whole life. B, term insurance. C, index universal life. D, variable whole life. Well, anytime you see variable, know that the owner bears all investment risks, and there are no guarantees. You can make a lot of money today, you can lose a lot of money tomorrow. The other thing, you have two accounts for variable products. You have two accounts. Now, regular insurance, you just have one account. That's the general account, right? For variable products, you have two accounts. You have this general account and you have the separate account, because the insurance company will separate. Hey, you know what? We don't want to put this risky investment with our regular funds, because we got a big claims with our general funds. So, you know, we're going to put, since you want to take that risk, fine, we're going to put your money in a separate account. Okay, so that separate account is for variable products, you know, because they want to contain the risks. If you lose all that money, they don't want it to affect your other accounts or other clients. So they put variable products in your own little account. You know, they have the general, but they also have the separate accounts. You can play with it. You want to lose it all, that's it. Now, variable products have a minimum guaranteed death benefit. Key word is minimum guaranteed death benefit. Yes, can your death benefit be adjusted? Yeah, but you have a minimum guarantee. So you say, okay, your death benefit was 250,000. You know it won't go below that. So anytime you see on a test minimum guaranteed death benefit, that's a signal. That's a hint that it's probably a variable product. When you know, these are keywords. When you see two licenses, variable product. When you see regulated by SEC FINRA, variable product. When you see owner bears investment risks, variable products. When you see there are no guarantees, variable products. When you see that requires two accounts, separate account, or you may say which one of these life insurance policies has a separate account. Well, only variable products have separate accounts. Now, what is the advantage of variable products? Variable products, the major advantage is the outpace inflation, right? They average at least 5% a year on average, right? Now, we know that inflation, the average inflation is about 3%. Well, that is what the government says, but the true real inflation is around 5% interest a year. So if you got your money somewhere and you're not making 5%, you're not getting 5%, you're actually losing money when you factor in inflation. And all of us know with prices going up, I mean, I think inflation is at 9 or 10% this year, right? So the major advantage of variable products is they actually outpace inflation. You know, on average, you know, they give you a higher interest rate. You know, the major disadvantage is there are no guarantees. You can lose all your money, right? So I hope that was able to help you to distinguish variable from regular. Now, you don't have to know both. I would say just know one, and and the opposite will be true of the other one. So another hint to help you with variable, usually when I think about variable, I think about tools. You know, variable comes in two. You have two accounts, a general account and a separate account. The general account is for paying your minimum guaranteed death benefit, and the separate account is, well, you can do whatever, that's for your investment You can do whatever you want. If you want to lose it all, that's fine. That's up to you, right? So variable account, variable products have, they usually come in twos. They have two accounts. They're regulated by, two governments, both the state and federal, government. You need two licenses to sell them, right? You need variable, you need securities and insurance license. So anytime you think about variable, think about two. You need two licenses to sell. You have two accounts, separate account in general, and it's regulated by two government agencies, two government entities, state and federal. So now let's come back here to these questions and hope you can be able to answer this. Let's come back to the question and make sure that you were able to get it right. Okay, so for question number one, what was your answer? Well, let's go ahead and read question number one again, and let's see this time with my explanation. Let's see if you're able to get it right. Again, you want to see what your answer was before, and now with my explanation, see if you can get it right. Okay, so question number one, I'll repeat. Which statement is true about a variable universal life policy? A says policy owner cannot select the premium mode. However, the policy holder directs investment. B says policy owner has control over where the investment goes and selects the amount of premium payment. C says all of the policyholders' premiums go into the insurer's general account. D, the policy owner has no control over where the premium is invested. So you can pause this right now and try to figure out what the answer is, but I'm going to go ahead and tell you what the answer is. So, well, let's kind of eliminate the wrong answers. Let's start with A. A says a policy owner cannot select the premium mode. However, the policy holder directs investment. Well, that makes no sense, right? It doesn't matter whether it's a variable insurance or it's a regular insurance. The policy owner always selects the premium mode. Your premium mode is just your frequency of premium payment. So what are the premium modes? They are monthly, so you can pay your premium every month. You can pay your premium every quarter, every 3 months, every 6 months, or every year, right? So those are the four premium payment modes, right? So now if you want, you can add a fifth one. Well, that's single premium. Okay, so policy owner cannot select premium mode. Well, that is wrong, because we know you as the policy owner, you have the right. It doesn't matter what type of insurance, you have the right to select how frequently you want to make your premium payments. Now, the second part of that question is, second part of that answer is right. It says, however, the policy owner directs investment. Yes, for variable products, the policy owner directs investment. That's true, but the first part of that answer is wrong. Policy owner cannot select premium mode. That is wrong. So therefore, A is wrong. Now, let's get to C. No, let's jump over B. C says all of the policyholders' premium go into the general, the insurer's general account. As I said a few minutes ago, no, because at the end of the day, the insurance company doesn't want to take that kind of risk, right? So they don't want to mix your risky investments with safe investments. So for variable products, they are risky, right? People can lose all of their money in their cash value. So the insurance company will separate them out, right? So they'll put the insurance company have the general account and they have the separate account. The separate account is where they put all your money for variable products. So we know that C is wrong because it said the policy owner's premiums go into the insurer's general account. They say all. No, not all. Some of it will go into the general account, but most of it will go into the separate account. So we know that is wrong. Now we come to D. D says the policy owner has no control over where the premium is invested. We know that is false, right? Because one of the one of the beautiful things about variable products, variable insurance products is, hey, I am the boss. I call the shots, okay? I call the shots. So if I want to invest in, in stocks, if I want to invest in blue chip stocks or, high yield stocks, whatever, or mutual funds, I call the shots. If I want to invest in Apple or Facebook, I call the shots. Okay, so that's some people may consider that an advantage, right? So the policy owner has control, over where the premium is invested. But D says policy owner has no control. So we know that is wrong. So the correct answer here is B. Policy owner has control over where the investment goes and selects the amount of the premium payment. So B is the correct answer. So if you got B, great job. Now let's come here to the third one. The second question. It says a blank insurance has a guaranteed minimum death benefit. Remember, guys, on your exam, you may not know every single thing, right? Because I mean, it's a lot of material. And for those of you who are doing life and health at the same time, taking the combination exam, I usually recommend against that. Break them up, separate them. Do your life insurance first, like your life insurance exam, and then few days or few weeks later, you can take your time and study for the health, right? So on your exam, one of the things I teach my students is you won't know everything. I mean, it's impossible to remember every single thing because it's a lot of material, but you can remember clues, hints, keywords. When you see keywords, that helps you to narrow down your options, right? So what does this question say? A blank insurance has a guarantee minimum death benefit. So by the time I see guaranteed minimum death benefit, I know it's either a variable life insurance or variable universal life, but I know it's variable, right? Then it goes further. It says the face amount can increase or decrease based on how well the stock market performs. The face amount is the death benefit. So for variable products, the death benefit can increase or decrease, but that is why you have a minimum guaranteed death benefits, right? Because the death benefit can increase or decrease. So that tells me it's still variable. So it says it also affords the policy owner the choice of sub-accounts to which cash value can be assigned and a fixed premium. Now, anytime you see the word fixed premium, that's a clue for whole life. Guys, keywords, keywords, keywords. Fixed premium, anytime you see fixed premium, whole life. That's one of the distinguishing features between whole life and universal policies. Universal policies have flexible premium. Whole life policies have fixed premium. Yeah, I'm paying $100. That's $100 I'll pay for the rest of my life or for my whole life. Universal is flexible. You can increase or decrease your premium. Okay, so by the time I see fixed premium, I know it's variable, and I see is guaranteed minimum death benefit. I know it's no, I'm sorry. By the time I see fixed premium, I know it's whole life, and I see guaranteed minimum death benefit. I know it's what variable. So it tells me it's variable whole life. And A says equity index. No, it's not variable. It's equity variable. No. B says variable life. As I said, variable life is the same as variable whole life. So B is the answer. C says variable whole life. D says variable universal life. It would have been variable universal life if it didn't say fixed premium. But the key there says fixed premium. So I know it's a variable product, but because it says fixed premium, I know it's whole life. So it's variable whole life. So that is why B is the correct answer. So guys, it may seem very complicated, but when you break it down and you understand these little clues, and that's what Melinda says she's going to do no, she's interested in, in our one-on-one training, right? So for people who do our one-on-one training, we sit down with you because, again, I will say it many times, it's a lot of material. If you, for example, the printed material for Kaplan for life and health is 200 and no, 540 pages. Who has the time to read 540 pages or to study 540 pages? This is why the average first time pass for all the exam providers, the average first time pass is around 60%, right? Because it's too much material. So what I teach people is keywords, clues that can help you to increase your chances of passing. All right, so let's come here to the last question, question number 3. It says, which one of the following types of life insurance requires that the producers be licensed by the Financial Industry Regulatory Authority before they can sell the policy? Boom. Remember, if you see Securities and Exchange Commission or Financial Industry Regulatory Authority, you know it's a variable product. So let's see which one is a variable product. Adjustable life, no, that's a fixed insurance product. Variable annuities, yeah, let's see. It's a variable product. So let's keep that in our pocket. C says universal life. Nope, not variable, so out. D says variable universal life. So our option is between B and C, variable annuities and variable universal life. But guys, you have to pay very keen attention. It says, which one of the following types of life insurance policies? It didn't say annuity. If they had said annuity, then the answer would have been variable annuities, but this says life insurance. So the only variable life insurance in this answer is variable universal life. So the correct answer is D, variable universal life. Voila, that is it. So I hope this was able to help you guys. Again, for those of you who want one-on-one training, because this is what I do with my students, right? One-on-one, I will not stop until you're 100% ready to take your exam. So if you're interested in one-on-one training, again, my number is in the description. My email is in the description. I'm pretty responsive. If you call me, weekdays during business hours, I usually return calls. You can call or text. I usually return calls and texts within 1 hour most of the time. But definitely I'll return your call. Or I'll call you back within 24 hours. Worst case scenario, but most of the time, if you call me between 9 a.m. and 5 p.m., I'll return your call within 1 hour, or if you text me, I'll call you back within 1 hour. So again, our pass rate, guys, the industry average, for all of the exam prep providers combined, average is about 60% for first time pass rate is around 60%, right? For us, for our one-on-one tutoring, our pass rate is 95%. And the good thing is our tutoring, you have a 100% money back guarantee. Let me repeat that. You have a 95% chance of passing, but just worst case now, you're part of the 5% that for whatever reason don't pass their exam the first time. You get all your money back, no questions asked. So you have nothing to lose, right? Worst case scenario, you will get some free training, right? Worst case scenario, God forbid you're part of the 5% that don't pass, you will just get your money back and you got free training, right? So, and then the other good thing about our one-on-one tutoring is around the clock, right? We have our tutors, it's around the clock. So if you want someone to tutor you at 2 a.m., bam, we have someone for you. Someone can get on Zoom and tutor you. If you want someone to tutor you at 6 a.m. or 10 p.m., any time of the day, 24 hours, we have someone to tutor you. So, guys, in the industry right now, in the insurance, pre-licensing, prep industry right now, you have about between 8 and 10 um, companies that do what we are doing, and we are the only ones that are providing on-demand training 24 hours. Anytime you want to get trained, you have someone 100% money back guarantee, no questions asked. Our pass rate is 95%. What do you have to lose? Nothing. But you have everything to gain, because at the end of the day, you can do everything you want to do. If you don't have that license, too bad. You can't make money legally. You cannot make money. So that license is worth every investment, right? So whatever it takes, get it done. So Melinda, again, thank you very much for the kind words today. This is a shout out to you. I hope you are listening to this. So guys, if you have any questions, any concerns, reach out to me. Again, my phone number is 202-855-6294. Again, 202-855-6294. My email is minzopass@minzopass.com. So that's minzopass@minzopass.com. Again, I have that in the description. So I hope you guys enjoy this episode. I hope you learned something from it. Hey guys, this is not like your regular podcast where you just listen to it one time, right? Your podcast episode. If you know, hey, if especially for those of you who got all 3 questions wrong, hey, you can listen to this 2, 3, 4, 5, 10 times, as many times as you want to, right? But listen to it over and over, go back and understand, because it's a lot of material, but when you really understand, and that's what we are good at, we really break it down, we bring it down to every day, to your level for you to understand. Because once you grasp it, once you understand it at your level, not at the insurance level, because they use all these insurance jargons, cash value, savings account, we use all this, cash surrender value. Well, cash surrender value is your equity, right? So pretty much we simplify it, dumb it down so you can understand. Because once you understand, then it doesn't matter how much they twist and turn the question, you will still get it right. That is why, guys, it's not a magic. That's why our pass rate is 95%. So hope it's not too much talking. Again, reminder for those of you in Washington, D.C. and Texas, keep an eye out. Our course should be coming out soon. So now we'll also have our, we're going to have our self-study, online self-study, similar to Excel or Kaplan or AD Banker, all these or ExamFX. Now you will be able to go at your own pace, and it's going to be, man, it's going to be the best, okay? Hands down, it's going to be the best. So I'm excited about that. That should be coming out soon. All right, guys, wish you all the best. For those of you who are taking your exam soon, wish you good luck. And until next time, please be safe.